In our video last week, titled, Where Are Private Equity Firms Finding Deals in 2023? We talked about the increase in take-private deals in 2023. Just a reminder, a take-private transaction is when an investor, usually a private equity firm, will buy all of the shares of a public company and take that public company private. In other words, the public company will no longer be listed on the public markets, and it will be privately owned. Well, in our June 2023 video newsletter, which you should subscribe to in the link in the description below if you don't already receive it, we took a deep dive into the Qualtrics deal, which is one of the largest take-private transactions in 2023, where SilverLake, CPP Investments, and other investors brought Qualtrics private for approximately $12.5 billion. To learn more about the Qualtrics deal, stay tuned for our Mink video newsletter. In this edition of Mink we will walk you through the Qualtrics deal, a recent deal where SilverLake, CPP Investments, and other investors bought Qualtrics. We'll go through the history of Qualtrics, followed by the details of the deal, and then we will analyze the deal. So let's get started with the history of Qualtrics. Back in 2002, Ryan Smith and his father Scott, a university professor, started Qualtrics in the basement of their home. Qualtrics was software that helped universities and companies receive data on students and customers through surveys. The company grew quite a lot over the years, with the rise in demand to collect and analyze data to make data-driven decisions. By 2012, Qualtrics claimed to have 600 universities and 4,000 companies such as Microsoft, Toyota, and Vodafone as its customers. At this time, Qualtrics received its first institutional investment. This was from Excel Partners and Sequoia Capital for $70 million. The company grew quite a lot before receiving this venture funding. In 2014, it raised $150 million from Insight Venture Partners, as well as Excel and Sequoia, bringing the company's valuation to over $1 billion. In 2017, it raised $180 million from the same investors as the previous round. And in 2018, SAP, the large German software company, bought Qualtrics for $8 billion in cash. And in 2021, SAP brought Qualtrics public in an IPO and maintained a majority stake in Qualtrics. The list price was $30 per share. It opened at $41.85 per share, and it finished the day trading at $45.50 a share, which is a market cap of approximately $27 billion. Well, just a couple of years later in 2023, tech valuations softened, and the opportunity for private equity investors to take Qualtrics private arose. And that's what sparked the deal we will be talking about in this video. So let's move on to the details of the deal. SilverLake, CPP Investments, and other investors bought 100% of Qualtrics at a valuation of approximately $12.5 billion to take the firm private, which was at a stock price of $18.15 per share. Before this transaction, SAP was still the majority owner of Qualtrics. So let's analyze the deal. Well, let's look at the valuation of Qualtrics over the past 5 years. In 2018, it was $8 billion. In 2021, it was approximately $27 billion. And in 2023, it was approximately $12.5 billion. Just look at this stock chart from when it went public in 2021 until the recent takeover announcement in 2023. How does this happen? Well, when a large company such as SAP buys a company such as Qualtrics, it is going to do its best to seamlessly integrate Qualtrics with its existing software and culture. SAP had more difficulty than it anticipated, so it decided to sell Qualtrics so that SAP could focus on its core products. With that said, a driving reason for the change in valuation is the change in multiples of the tech sector in the public markets over the past few years. The challenge with the public markets is that investors focus more on the short term, which results in quite a lot of volatility. After the pandemic hit in early 2020, tech stocks rose, and understandably so. But they rose so much that valuations were no longer practical, in my opinion, of course. Many tech companies went public because of the high valuations they could receive in the public markets. According to Ernst & Young, IPO proceeds from technology were over $140 billion in 2021. Well, what goes up must come down. And as you can see, IPO proceeds from technology were less than $40 billion in 2022 and have continued to slow in 2023. Now, what happens when public market valuations are low? Well, private equity firms will buy up these public companies and take them private. Investors, private equity funds are sitting on a lot of dry powder to spend, and they are looking for ways to deploy that capital. If public markets continue to decline, private equity funds will be taking a lot more public companies private in the future.